Good morning and welcome to COBRA. As you know, COBRA is a pro bono initiative created just when lockdown went into, as we went into lockdown, offering pro bono assistance to businesses in financial distress due to COVID-19. We offer a whole range of services to assist companies in turning themselves around: legal, accounting, financial. If you would like any advice on other aspects with regard to your business, COBRA is available. It is a pro bono initiative founded by Schindler's Attorneys, Engaged Business Turnaround, and IQ Business. Today we've got a very exciting show with our in-house experts from Singular. Lorenzo Tencati joins us again, and we've got a prestigious guest, Dr. Adrian Saville. He's also joining us on COBRA. What an absolute treat to have Dr. Saville, a great mind, and he will take us through the recession, the recession we appear to be in at the moment, and how we can get out of it. So before I ask Rohit of Singular to introduce Lorenzo and Dr. Saville further, I'll just go through the CVs of Lorenzo Tencati. Lorenzo is a serial entrepreneur and investor. He has years of experience in the economy, and is still a director of the Singular Group, a global management consulting firm focused on emerging markets in Europe, and the Winterberg Group, a private equity investing firm focused on growth capital in Central Europe. Dr. Saville holds a Bachelor of Arts cum laude, an M.Com cum laude, and a PhD in economics, for which he was awarded the Economic Society of South Africa's Founders Medal. He's a UNESCO laureate, a matriculant of the Linacre College in Oxford, and has completed programs in investing and competitive strategy at New York's Columbia University and Harvard Business School in Boston. In 1994, Adrian formed an investment vehicle at today's Canon Asset Managers, where he serves as chief executive. He holds a professorship in economics, finance, and strategy at the Gordon Institute of Business Science, and is the author of the Visa Africa Integration Index 2012 to 2020 and the Investec BIBS Savings Index 2015 to 2020. He has presented to audiences in many destinations, including Botswana, Brazil, Chile, Estonia, France, Germany, Ghana, India, Japan, Kenya, the Netherlands, Nigeria, Rwanda, Singapore, the United Kingdom, United States, Zambia, and Zimbabwe. We also are joined by Carl Ferreira. I didn't mention him. Carl Ferreira completed his BCom degree at the University of Witwatersrand in 2019 before joining Canon Asset Managers. He's a colleague of Dr. Saville's. As a member of the investment team, his responsibilities include economic investment research, performing financial modeling, and producing investment reports and presentations. Carl will be part of the panel, which also includes Renee from IQ Business. So Rohit, it's over to you. Thank you. Rohit, are you with us?
Right. Good morning, everyone.
Thank you, Rohit.
Thank you for that introduction. I would like to introduce the two panelists for today. Today, as a panelist, we have a good combination in terms of giving a view from the academic side as well as from the corporate side. Our two are Lorenzo Tencati and Dr. Adrian Saville. So briefly introducing both of them. Lorenzo is a serial entrepreneur and investor. Over the years, Lorenzo and is still a director of the Singular Group, global management and consulting firm focused on the emerging markets, as well as the Winterberg Group, which is a private equity investing firm based out of Central Europe. Lorenzo started his career at Bain, and he holds an MBA from London Business School and a master's and bachelor's degree in industrial engineering. Adrian is an economist, educationalist, and an investor. Adrian founded and is currently the CEO of Canon Asset Managers, an investment vehicle associated with the BizBez Group. And he also holds a professorship in economics, finance, and strategy at GIBS. Adrian holds a BA, MCom, and PhD in economics, for which he was awarded the Economic Society of South Africa Founders Medal. He's an UNESCO laureate, a matriculate of Oxford School, and has completed programs at New York's Columbia University and Harvard Business School in Boston. I would hand over to Lorenzo now to take us through the interesting session that we have planned for our audience today.
Super. Thank you, Rohit, and welcome everybody. And great to connect again and to be able to give us or give you via Singular Compass our perspective on how things are unfolding in South Africa and how we think they could be unfolding in the future. Specifically for the ones of you that are sort of a loyal audience, what we typically do since the beginning of lockdown within Singular Compass is try and really sort of provide a level-headed perspective to leaders and decision makers in South Africa, given the amount of information overload and confusion that is out there and is going to be out there in the next few months. So usual structure: first an initial part on healthcare and economics, then we'll deep dive into the economy, and we'll finally have a view on how the impact of the health crisis and the economic crisis that comes from it is gonna sort of play out on businesses. In particular today, and thanks a lot, Adrian, for joining us, we will actually be looking at, so when it comes to the last chapter, and that's why we invited and we gladly welcome Adrian today, we'll try to actually correlate or relate the impact that this kind of a crisis has on GDP vis-a-vis what can actually be expected from a corporate perspective. So if you are a business owner, what can we expect? What happened in prior crises? What do we know? And what do we need to be prepared for? And also, where is really the bottom? Because a lot of conflicting messages are being told to us by the media these days. Okay, let's jump into it. Rohit, if you don't mind flipping forward. Okay, I think we have a little bit of a connection issue on the slides. So let me, while Rohit reloads the presentation, let me start actually walking you guys through the key messages. I mean, the first, and that's the way really we usually start the analysis, is looking at, so putting South Africa, when it comes to the healthcare situation, the healthcare crisis, is putting into perspective vis-a-vis other countries. Now, where we are right now is, and of course the message is very different vis-a-vis what I was giving you weeks ago, but where we are right now is we are closing the gap vis-a-vis the European countries and the bulk of the countries that have been, let's say, heavily affected in terms of growth of cases and also growth of and also growth of fatalities. In the meantime, I don't know if Rohit, you're managing to know, we don't see your screen, Rohit. So let me try and maybe share. I could try and share mine. Let's see. Can you see my screen? Can somebody give me a...
Yep, that looks good.
Okay, perfect. Let me just... view full screen. Okay, perfect. So as you can see on this chart, basically we started. South Africa started, let's say, in a relatively, so increasing the number of cases at a relatively slow pace, but increased the pace as we got to the last sort of couple of months. Right now we are closing the gap, unfortunately, vis-a-vis the European countries and more recently the Latin American countries. However, the good news is that from if you look at this chart from a death per million people, per population, South Africa is actually still the magnitude of the impact of the healthcare crisis is still relatively low compared to Belgium, compared to Italy, compared to the USA and even Brazil. So on the one hand, catching up fast. On the other hand, still in relative terms, we are actually at the 32nd sort of place if you look at ranking countries on a death per million population basis. So still, let's say, good news there. There is a caveat, however, and the caveat is in the following chart that we're sharing here, which actually highlights quite a large number of excess death vis-a-vis. So if you compare the number of deaths that we had in South Africa, and obviously that needs to be seasonally adjusted, over the past, there is a large number of unexplained deaths, which you can see on this graph. So the dark blue is the number of COVID reported deaths, and the gray is the number of unexplained and unexplainable, if you look at yearly normal patterns, extra, so excess deaths. So that obviously, I mean, the most natural sort of assumption to take would be to say that those deaths are with a quite high likelihood linked to actually linked to COVID. If that was the case, then of course the message that I shared before would change quite dramatically, in the sense that South Africa, if those deaths, those excess deaths would be attributed to COVID, South Africa would jump to the 8th to 10th, 13th place in terms of death or casualties per million people, which obviously puts South Africa in a much different spot. So we need to live with the ambiguity and with probably keeping in mind that this is the range of gravity of what's happening so far in South Africa. We will only know most likely in the next few months when the numbers will be refined, if at all. Okay. So when it comes to looking ahead into the future, because obviously we're interested mostly in what's ahead of us and what are we expecting. If you think about what's ahead of us, the best way to predict that is to look at countries that have already gone through the first wave. And if we overlay the curves of countries such as, or the shapes of the curves of countries such as Italy, UK, and Spain, for argument's sake, or for example, one could infer that we're very likely to go down in number of cases by roughly 90%. So in other words, we will decrease in number of daily cases by 90% over a time period of roughly 2 months. And given that we are more or less at the peak of cases, that means most likely end of October, mid of October. End of September, mid of September. So that's when the situation cases-wise will have most likely stabilized. If that's the case, then we will be sitting at the end of October looking back at roughly, most likely, in the 20 to 30,000 casualties, which is obviously a very, very large number. So that's more or less what we expect is ahead of us. There is 2 wild cards that we need to consider that are still, let's say, of which the impact is still unknown. One is the second wave, and the other one is the vaccine. So as we know, obviously the extent to which this is a wild card has changed over the weeks and over the months, in the sense that we know that there will be a second wave if there is no vaccine. But we also are optimistic by looking at other countries that the size and the magnitude and the gravity, so the ratio of casualties vis-a-vis cases of the second wave, will be much smaller than the first wave. But it is still obviously a wild card to some extent. The second wild card is obviously the race to a vaccine. We've all heard about the Russian news in the last couple of days. And we've obviously got a very, very full funnel of vaccines that have been going through phase 1, phase 2, and phase 3, and now are a couple of them are actually under approvals. So we're getting very close to a stage where the vaccine could start being actually spread at scale. So we're very, let's say, hopeful about it. We need to be also realistic that the speed at which that will scale will still take a couple of months, even in the most optimistic of cases. But I think this wild card or positive wild card, I think, brings a certain degree of optimism, which we've also seen in the financial markets, by the way. We've spoken about the extent of the fatalities. I mean, this is a model we run, a statistical model we run with NMG, and we will publish on LinkedIn the full document. So every one of you is happy to feel free to read in detail the assumptions that underpin our calculations. But I've sort of quoted the headline figures of casualties, which is what obviously we are most interested in, because that's what makes up for the tragedy. So now let's, we've given a little update on health and healthcare. Let's look at the economic impact of what has happened and what will happen from an health and healthcare perspective. Now, so this is, as we've been saying since very much the first week of lockdown, this was going to be and is going to be the biggest economic shock since the end of Second World War. So we have to start with a realistic expectation when we look at these numbers. Let's get into the depth of it. I mean, if we look at the confidence level, the business confidence index is roughly in South Africa. This is South African figures, and it's the first graph on the top left. It's roughly 20-25% below what it was. That's right now, and below what it was at the bottom of the global financial crisis. So it's clear that people are aware of, businesses are acutely aware of the gravity of the situation. Unemployment rates have also increased substantially, and they're projected in South Africa to hit possibly a peak of up to 40%. In the rest of 2020. That's obviously a gigantic number, especially if we consider the definition of unemployment in South Africa, which doesn't fully, not only in South Africa, but doesn't fully, give the extent of the picture, because obviously it takes into account the active part of the population. I will not dwell into the other two graphs for now, but obviously they provide more, even more, let's say, arguments and backing to this picture. Now let's look for a second at what citizens are feeling. This is an analysis, a very interesting sort of analysis that has been done by Ask Africa since the beginning of lockdown. So the nice thing is that here we can see the trend. We can see how the perception of the average person, the average citizen, evolves over time. Now, the first thing that is clear is that it's very clear to the average Joe that unemployment is a bigger, so economic impact, in other words, is an even bigger worry than that of contracting the virus. So the average Joe is acutely aware that this is going to be an economic, hopefully an economic damage bigger than the, or let's say the economic fear that is warranted is bigger than the healthcare fear, which is still high, but not as high. We see the same in the distress index. So roughly a third, just to give you the orders of magnitude, roughly a third of the people, interviewed people, which is a large sample, have they're suffering from hunger. So this is needless to stress how much of a basic need that is, and roughly a fifth are or claim to be under severe financial distress. Now, the worst, clearly, in terms of data, has to come because we still don't have a Q2 figure for South Africa, what we know for a fact is that a lot of countries have issued their Q2 numbers, and the picture doesn't look very promising, of course. The more, and you see on this chart, actually the contraction of 2020 vis-a-vis 2019 for Q2. So these are the numbers that are still to be issued for South Africa. The expectations for South Africa are in the range of 15 to 20% contraction. So very much closer to the high end of the scale. Needless to say, countries that, it's interesting to look, for instance, at countries like Sweden that didn't enforce a very strict lockdown, or they didn't enforce a lockdown at all, obviously see an advantage from an economic contraction standpoint in relative terms, because they didn't constrain the supply as much as other countries did, such as, for instance, Italy, which sees a contraction of 12.5%, or even countries where, like the UK and Spain. Spain for the lockdown, and UK possibly for slightly different reasons that are more linked to the mix that composes the GDP. So in other words, to the sector mix in the GDP. The good news, so let's always try to sort of balance, let's say, hope with threats. The good news here is that I think as humankind, we're getting better and better at managing recessions. And the extent, also, even if we just look at the extent of the stimuli that have been already injected into the system by large central banks, the likes of the US and Europe, but also South Africa has moved quite early and quite aggressively in that from a monetary policy perspective. We are getting better at managing recessions. The extent of the stimuli is 2 to 5 to 6 times bigger than the extent of the stimuli in the financial that were injected into the economy in the financial crisis. And that will show, and is already showing in the financial market, and is in a way a forced move that we're very glad to see. It will have unintended second degree, most likely consequences. So we shouldn't expect that those unprecedented and very aggressive moves from central banks will come at no unintended consequences, but certainly it is helping and was a forced move in a sense to be able to stimulate the economy in the short term. And we see that in the fastest, on the right side of the slide, in the fast recovery that we're actually seeing. So we're obviously seeing an unprecedented fast drop in the purchasing managers index. For instance, we show on this slide the US and China, but we're also seeing an unprecedented speed in picking up, especially if you look at China, which had a very mild second wave. What we always do is we update our economic forecast for 2020. So we've done that today. Our best case to worst case ranges between a contraction of 8% and 13% for the whole year. That means a Q2 contraction of roughly, between 20, in the order of magnitude of 25%, which is an even bigger contraction than what, let's say, mainstream institutions are expecting. We hope to be wrong, of course, but we see a big impact of the supply constraint combined with the demand effect that basically is that the negativity that businesses and consumers, the negative mindset that they are in, and therefore the cutting of their spending, we see that having a big impact, especially in the short term. So now let's maybe close this chapter by looking more qualitatively at what are the biggest threats and the biggest opportunities that are out there from an economic standpoint. So in other words, if we look at what could happen and what could we do as a country, and what could be, we painted it on the slide as the sharks around the island, because these are very much the threats. And I mean, the number one is obviously the rising debt servicing cost, which is something that needs to be monitored. So obviously the country is the debt to GDP ratio is increasing, and the more you have debt that is denominated in other countries' currencies, the more the cost of servicing that debt becomes or gets out of your control. So that's clearly something to keep a close eye to. The second part is obviously the load shedding. I mean, it seems, if you want, trivial to mention here, but that has a very big impact not only on the real economy, but also on the perception and therefore an investor sentiment outside of the country. The way government will deal with the SOEs and especially ESCOM is certainly the third big shark out there. And the world is looking at how that will be dealt with and how the IMF loan will be used in that respect. The fourth big shark is obviously very externally driven. I mean, South Africa relies to a very big extent on exports, especially commodity export. That's very much linked to China. Because China imports those commodities, and in turn, China sells those finished products, and in sales are very linked to the global GDP. So that's so China and indices related to China and Chinese industrial production is very much one key indicator to be on the lookout for. The more trade barriers escalate, the more we see that disruption increasing, the more likely we see that affecting also the global GDP and therefore the commodity markets and therefore South Africa. Number five is obviously the volatility in the financial markets that will, I mean, capital outflow out of the rand obviously increases the cost for South Africa to finance itself and reduces therefore the scope of the central bank to reduce rates further, which obviously in turn helps the economy. These are really five things that are, if you want, big threats out there, but certainly indicators to keep watching to see how things will unfold in future. Let's end with four positive notes or positive, let's say, points of hope. The first one is the fact that on the one hand, there is a big energy crisis in South Africa. On the other hand, there is a massive opportunity to accelerate the country, to use the new energy paradigm to accelerate the country into filling that gap and also into economic recovery. South Africa is one of the better endowed countries globally by far when it comes to renewable resources. And it's also quite endowed with natural gas off the coast and close to the borders to South Africa. I mean, we all read the news about the Mozambican gas field. So I think the resources are there and the endowment is there. It's really just about tapping into it and allowing the private sector to make good use of it. The second one is obviously an opportunity to use especially the IMF funds to boost physical infrastructure spending, which in turn will boost employment, which we've seen is a major issue, and is going to be a major issue going forward for South Africa. It was a major issue also, and already before the start of the COVID crisis. Now, the third is the riding of the digital wave, so ensuring more affordable connectivity and increases access to digital platforms. The world will just go into digital at a much faster speed than it has in the last few years. We've had the increase in digital penetration that we would have had in 5 years, we've had in 3 months. So that's just about really the only lever we have to create financial inclusion and lower inequality, to build those infrastructures for everybody. And for sure, the more we, the fourth big opportunity is to create or reduce the level of uncertainty for investors and easing restrictions and regulations for investors to attract local, but especially foreign investment. I mean, uncertainty on policy is the reason why investors are being sort of conservative towards investing in the rand and in South Africa. So said that, I would love to pass on the words to Adrian, because today we have the lack of having his valuable input in trying to understand and relate a little bit more to what we do, which is business. So how do these economic numbers and macro variables really affect us in the day-to-day basis, and how deep is the bottom going to be, and how what can we expect, in other words? So Adrian, I'll pass on to you, and feel free to let me know when you wish for me to
Lorenzo, thank you. I'm sitting outside in a very beautiful Johannesburg late morning or midday with my Hardy-Dar neighbors, and so it's my pleasure to share a few minutes with you to talk through the economic and business circumstance. Before speaking to this slide specifically, I think it's worth taking a step backwards very briefly to remind ourselves of the important distinction between risk and uncertainty. And Frank Knight, the University of Chicago economist, 100 years ago, in his book Risk, Uncertainty and Profit, made the important distinction between the two. That risk is odds. If you flip a coin, you get a head or a tail. You get a good outcome or a bad outcome. And you have a sense of quantifying the odds. Uncertainty is where the odds become unknown and you move into the world of unknowability. And that distinction is important because in the world of uncertainty, odds are replaced with unknowability. In the world of odds, or in the world of risk, you can insure against risk, you can protect against risk, you can plan for good or bad outcomes. In the world of uncertainty, risk is replaced with the fog of unknowability. And in the fog of unknowability, where visibility is exceptionally poor, confidence plummets. And Lorenzo has already made the point around domestic confidence having plunged in South Africa to record lows since the data began in the 1960s. So, sorry, 1980s. So against that backdrop, the ambition in our work that we're going to share with you in this time, that my colleague Carl Ferreira has done with me for the singular presentation, is to try and shine a light through this very, very uncertain environment and to remove some of that unknowability. And if we can push that aside, then there is a prospect of building or rebuilding with confidence and with greater clarity and greater visibility. So the data that we're showing you on this chart is the relationship between world economic growth, that's the gray column, and the thin line is the bottom line performance of the companies that make up the MSCI All World Index, All Country World Index. It's 2,000 giant companies. And although the data doesn't map quite one-to-one, they walk together fairly closely. In fact, the correspondence here is about a 0.7 correspondence, by which we can infer that 70% of your companies, and I'm speaking now in a sweeping aggregate term, 70% of your company's bottom line performance is going to be influenced or determined by the economy. It's a strong relationship. It has high explanatory power. And if you want to know what's going on inside of your business, this data suggests have a look out the window, because what's going on outside of the window in terms of the broad economy is going to have a material, significant impact on your business. In normal times, this is a much harder point to make. But in a world in which the global economy is going to shrink by 5%, so that's the the deep column that you see for 2000, that's the IMF forecast for a 5% decline in GDP, world GDP. It translates to about a 40% decline in company earnings, that the companies that make up the MSCI All World Index. If you flip to the next slide, Lorenzo, and we'll come back to talk about recovery in a moment. Having made the observation at the world level, that's captured in that top left-hand block, and it says the correlation between world revenue and world GDP is a 0.7 relationship, and the correspondence with earnings is about a 0.6 relationship. So whether we're talking about company performance, just in terms of revenue growth, top line growth, or company delivery in terms of profitability and the sustainability of margin, it's a 0.6 or a 0.7 relationship between world economic growth and company outcomes. What we've done below this is we've disaggregated that headline number into industries, all of the major industries, energy, materials, industrials, all the way through to utilities and real estate. As we move from reds and oranges to green, there is a lifting of the correlation, which suggests that the industries that have those green blocks are industries in which you have some degree of divorce. So lack of correlation doesn't mean you have immunity, it just means you behave differently. So the low correlation could either mean that you are divorced from the world economy, that arguably is the case in real estate, which is a highly geared industry, or you have immunity, which is arguably the case, or a degree of immunity, which might be the case with utilities or communication services or information technology. And Keval, this might in some way help answer the question that you put to me in the chat, and that was about these big tech giants that have gone on to take dominant share of the S&P. Well, they're tech, and they've got a degree of immunity and divorce from the damage that is being experienced in many other industries. If we go on, Lorenzo, what we've reproduced here is that world chart, but replaced the analysis with South Africa. And so this shows you the performance then. The columns is South Africa's economic growth, and the lines is South Africa's Johannesburg Stock Exchange All Share Index earnings. The relationship, again, is a strong one. It is about a 2/3 relationship, which says 2/3 of the JSE's performance can be explained by the South African economy. And what we've got going on in 2020 is the economy shrinking by 10%. That's that column digging all the way down into the earth. You can read that against the left-hand axis, -10. And the thin blue line is earnings response, and it points to South Africa JSE listed companies shrinking earnings by 30%. There's there's a couple of notables in this. The first is that on balance, South Africa's economic growth is spending a lot of time very close to the zero line. So this is the conversation about South Africa redressing or addressing the structural challenges. Lorenzo spoke to some of these. The second standout feature to us in doing this work is that South Africa's -30 earnings is lower than the world's -40 or 50. How on earth can that be, given that we are a commodity-based open economy with a high degree of fragility? And the explanation for South African listed company immunity is the rand-dollar effect, that about 60% of JSE earnings are dollar denominated, and the rand has moved from 14 to 17 to the dollar over the course of this year. The second is commodities have recovered with extraordinary buoyancy. Most notable in that set is gold, and we see the likes of Anglo Gold, Harmony, Goldfields, and even some of the juniors, DRD Gold and Pan Africa, really sitting up with big earnings buoyancy. And then the third is what we refer to as the Naspers effect, that although the company is JSE listed, it's not South African resident. And Naspers is a great case in point. Richemont is another obvious case in point, where they're big listed companies, but they're not really domestically oriented. And that leaves then the discussion about the performance of South African facing businesses and the relationship with the South African economy. And for many, this is the end of the conversation, where they've gone into business rescue or bankruptcy from which they won't recover. And there are some of the very harrowing experiences referenced in the logos here. If we flip to the next slide, what this work shows, and this has evolved as we've been developing this research project for today's conversation with COBRA and with Singular, was the importance of distinguishing the impact of the country or the economy on the company, and then the ability of management to respond and react to that circumstance. So measured across the horizontal axis is the sensitivity of the industry at the global level, the sensitivity of industry to economic growth, and that's measured by the correlation of revenue to world economic growth. And unsurprisingly, highly sensitive are industries like consumer discretionary and materials. Measured up the vertical axis is evidence of the ability of management to respond. And the way that we distinguish this is businesses that sit above the line have a earnings response that has lower sensitivity to the world economy. In other words, they're able to get a better result at their bottom line than what they're experiencing at the top line. And the standout here is healthcare, where healthcare not only has very low sensitivity to the world environment, but the management of healthcare businesses seems to evidence an ability to respond. By contrast, you've got financials with very low sensitivity. Now that's surprising, and it's explained by the contracting nature of financial arrangements. And although financials are very often highlighted as the first to retrench and the swiftest to cut back lending, what you see is a very low ability of management to respond to the circumstance. And that's captured by that financial spot being low down on the vertical axis. What on earth is going on here? It's that what's happening to financials is they're having to report on non-performing loans and write-downs, which is out of the hands of cost controls. So we think that this is a really instructive analysis of which industries are going to experience the highest impact at the revenue level, and which industries are likely to be able to translate management responses into business performance. Of course, these are headline numbers, and they are in no way the ability to comment on individual businesses. If we go one more, Lorenzo. What we've done in the balance of the work, and you are very welcome to access this copy. We will share the full report with you across all of the sectors, is we've just made comment on the individual sectors then. And this starts to speak about the prospect for recovery, and that's the visibility that I made reference to. So to borrow from another industry commentator, Nassim Nicholas Taleb, the author of Black Swans and Anti-Fragile, he says, to not foresee a tsunami or a market crash is forgivable. To build something that is fragile is not forgivable. And if we know that recovery is on its way, our task as executives, as management teams, as business owners, is to work on the recovery and the rebuild, and to build enterprises and entities that are anti-fragile. in light of this recovery that stands ahead of us. And so this data shows you the anticipated recovery per sector. So this is industrials, which includes the likes of GE, Caterpillar, and you will associate your own company with specific industries. Shows the big recovery in earnings, as much as a 50% rebound in earnings in 2021. If we go to the next slide, this shows you the material sector. Unsurprisingly, the material sector is far more sensitive, not just at earnings level, but also at revenue level. So the top chart shows you the responsiveness of company revenue to world economic growth, and the bottom chart shows you company earnings to world economic growth. The right-hand illustrations show you the year-on-year stuff. And so from that, we can calculate the sensitivity. And this is the world of many South African businesses: Anglo American, BHP, Exxaro, Sasol, and others. If we go one more, this is the healthcare sector, which, very poor pun, displays one of the highest levels of immunity in revenue and earnings. And what's striking here is that earnings are not only are relatively divorced or immune from world economic growth, revenue and earnings, but they're also relatively dampened, that the volatility is that much damper. So if you're looking for a place to build something with a degree of certainty and knowability where there's much higher visibility, then this is a standout industry. If we just go one more, Lorenzo. Sorry, I thought we had our correlation chart. We don't, so we don't have to flip one more. I'll make the comment on the correlation chart. So what what this work talks to is being able to push aside some of the fog in the environment. None of this is should be taken as an explicit forecast that we are forecasting that earnings or revenue is going to sit up. What it highlights is the sensitivity of specific sectors and then your businesses to the external environment. James Carville, who is responsible for Bill Clinton's election all the way back in the 1990s, James Carville helped Clinton sharpen his election language to say, it's the economy, stupid. That was their big throwaway that got Clinton elected. And it is the economy. It was a much harder argument to make coming into COVID-19. But having walked through an environment with the deepest global and domestic economic contraction in 100 years, I think that point now is tragically and easily made. So our task is not to sit here filled with remorse and regret of woulda, coulda, shoulda, but rather think about how we can strategize and position for the recovery. And our sense is that this work brings visibility and removes a degree of uncertainty and replaces it with knowability. Thank you.
Excellent. Thanks a lot, Adrian, for this. That was very much insightful and appreciated. Shall we maybe take some questions from the audience? I see a couple of them have been already shared. I mean, one, Adrian, you've already actually addressed in your talk. Another one that has come from Mohammed is, where would you plot retail and manufacturing in those correlations? Adrian, do you wanna maybe take this one? I'm happy to comment after you.
Absolutely. Won't you flip back to that first correlation chart, which I thought we had also posted at the end?
This one.
Forgive me, that's the guy. So what that shows, Mohammed, is the relationship between specific sectors. And here you can get, sorry, what was that? It was retail and?
It was the question was on retail and consumer, I believe.
Manufacturing.
Retail and manufacturing. Retail and manufacturing.
Thank you. Thanks, Carl. So retail sits here in, it depends on which type of retail. So you can either think of retail as sitting in consumer staples or consumer discretionary. And if it's consumer discretionary, then this is shopping for leisure or pleasure. The relationship between revenue and earnings is very, very high. And we know this. I mean, we've seen the impact on footfall and revenue traffic in South Africa. Hyprop has reported an 80% fall in mall traffic in the South African environment. If it's consumer staples, and those are necessities rather than luxuries, then those consumer staples have a 0.4 correspondence, which still leaves you somewhat sensitive, but with far more resilience than the consumer discretionary. Manufacturing will sit in that industrials cluster, and manufacturing sits with, so that's the third one, the fourth one down, and manufacturing sits with much higher sensitivity. Again, these are at the level of industry, and it could well be that you are manufacturing hand sanitizer or you are manufacturing luxury Swiss watches. If you're manufacturing luxury Swiss watches, good luck. This is a very, very tough environment. If you're manufacturing hand sanitizer, you've probably had the best year on record. So we need to be very careful, with using these headline numbers and inferring then that what we see at the industry level applies to all companies, but this is a point of departure. We have other work which isn't shared here, but I can share that in another conversation, and that's at the level of company performance, and that uses bottom-up analysis to try and understand what the attributes are of businesses that give those businesses a difference to their industry behavior.
Yes.
But I think that's a very different conversation.
Maybe a quick comments on that in addition to what you said, Adrian. I mean, I think two things to really keep in mind is to sort of have a sense of what the correlation will be in your specific case is, on the one end, how much of a commodity is your product service. Obviously, the more that is the case, the less ability you have to influence it, or to influence, to make any changes, or to have a management impact that of your, let's say, vis-a-vis what the market is, what the market conditions are. So the level to which you're selling a commodity versus a very differentiated product. And the other one is the level of to which your costs are fixed versus variable. So the more you can influence your cost base, the more you can salvage your earnings vis-a-vis a more, let's say, fixed situation. So I think if you want to apply these, let's say, this framework to your own business, these two would probably be the best way to look at, or the biggest factors to think about when you look at how much will that hit you. So how much can I influence my pricing and my sales? And that typically is driven by your certainly your digital, let's say, channels, but also and especially and in general your ability to influence price, which comes from not selling a commodity, and secondly your cost base, how fixed it is versus variable. So if you're selling iron ore, you're stuck with the market prices. Very little you can do, and if your fixed costs are large proportions of your total costs, you take what the market gives you to a big extent. Yeah. So another question: do you have from Natalie? Do you have any information on comparative excess debt in other countries? Yes, that's Natalie, a very good point, because in fact, to do the fair comparison, one would have to compare South African, let's say, declared plus excess with the same in other countries. So typically, so those numbers are actually public. We have published some of them, and we can give you the sources. There's a very good study done both from the Financial Times and The Economist on this. So I can confirm that most countries have a very large, or at least quite a large amount of excess debts in those months. They're probably not as large as South African percentage on declared debt, but that's very much of a country by country situation. So it is very common to have excess debts, which means that we are not, and then there's no necessarily bad faith behind this. It's just that it's very hard to count if somebody dies alone in their home. How do you know what to attribute that to? You only know statistically ex post if you look at it looking backward, and you see that on a seasonally adjusted basis, this is most likely to be attributed to COVID. So that's the case. Let me see if we have another couple of questions. I have a question otherwise for you, Adrian, which is, I mean, you follow and you have been giving also interviews on other economies as well as South Africa. How do you see the South African case vis-a-vis the other countries that you followed more closely from an economic standpoint? So in other words, what relevance and what importance do you put to the threats and opportunities that I highlighted in the presentation, and maybe others that you think are as relevant?
So the work that you share in the early part of your presentation, Lorenzo, is really interesting to me, because what it demonstrates is the resilience, and I'm trying to find the right word, but people will know what I mean when I say resistance of economies to the impact of COVID. And there's some that have just done exceptionally well. They've managed the pandemic well. They've put policies in place that have been effective, and they are coming out in much better shape than others. And there are other economies where the impact has been pronounced, and they run a range of risks, including, amongst other things, also you flagged this, the chance of a second wave. And so who would stand out as having a degree of impressive resilience or resistance? Germany, some of the Nordic countries, and a couple of the Asian economies, in particular, South Korea and Taiwan are standout cases. Who has particular vulnerability? Spain and the UK. Spain, because it is overwhelmingly a tourist economy with a very strong Asian tourist, as a very strong Asian tourist destination. I happened to be visiting Spain in December and January. It's a country with 50 million population and 80 million tourists per annum. So, you know, if anywhere is vulnerable, it's that type of conduit or corridor. So this, I'm going to be very forgiving of Spain and suggest that it was almost out of their hands that they carried this very high specific risk. In the same breath, the responses of, and just before we go away from the UK, why would the UK be so much more pronounced than the other G7 economies? Because we've already seen Q2 economic data from the US, Japan, Canada, France, Germany, etc. And the UK stands out with one of the worst performances, as it is because it is overwhelmingly a services-oriented economy. And in that services sector, that's going to be one of the hardest hit by the slowdown, high social distancing, and then lockdown. If economies have resistance and resilience, then it can turn into not only an economic recovery conversation, but also a business prospect conversation. And I've made reference to South Korea, for instance, and in our investment portfolios, We are looking at the South Korean tire manufacturer, a business called Hankook, which has global market positioning. But if your home economy has done well, the world economy is recovering, and you've demonstrated a resistance and a resilience, which means your business balance sheet is that much stronger than many others, then you've got the investment magic of a supportive environment and a strong business.
Thanks, Adrian. We just a quick last couple of back and forth. I mean, there's one question from Clyde on, he's wondering about the potential resurgence of a second wave. Well, he's wondering specifically whether that has been taken into consideration in our estimates for GDP contraction. The answer is unfortunately no, in the sense that we have assumed in our estimates a relatively small impact of a second wave. So a second wave, a bigger second wave in South Africa than a relatively mild one would worsen our forecasts. So unfortunately, that's the answer. And then there's another one, which maybe could be our closing one. Adrian, what's your take on QE in South Africa? So the quantitative easing done in the South African case. I think you're muted, Adrian.
I'm about to make the schoolboy error of webinar.
The webinar muting exactly after 5 minutes of answer.
I better make this good. So Natalie, QE is not yet a conversation in South Africa because technically for QE to happen, you have to be at zero interest rates. And then only are you in the language officially of quantitative easing. But this is becoming a bigger story in South Africa, where increasingly policymakers are putting pressure on the Reserve Bank to throw rescue lines because they've run out of other policy options. And the more the conversation goes in that direction, the more anxious I become about the ability of South Africa to recover functionally and healthily. The Reserve Bank or QE cannot save South Africa from its structural problems. South Africa's structural constraints sit in the hands of National Treasury and other central policy organs.
Super. Thanks, Adrian. I mean, I very much share your view, and I would add to that I mean, you can be extremely impactful as a central bank if your currency is widely used and if your debt is denominated in your own currency. The less that is the case, the less you can really rely on your monetary policy, and of which QE is obviously the let's say the second instance, or let's say the extra tool that you can use after lowering interest rate. Yeah, so let's
I know we're out of time. I can't help myself but make this very quick observation.
Please.
QE could work if South African businesses responded to interest rates. Natalie and I know each other from other work that we're doing together on impact. And if South African industry businesses responded to interest rates, then you could point to QE as being a potentially very powerful stimulus. But there is almost no response in gross domestic fixed investment to South African interest rates. So it's like pushing on a piece of string to try and get economic recovery through interest rate relief.
Excellent. Well, thanks a lot, Adrian, for sharing your insights.
Thank you.
I hope we'll have more opportunities to share insights together. And Gary, I'll leave it to you to close off. And I thank you all, as always, for joining. And you will receive, if you're following us, if you're following Singular or myself on LinkedIn, you'll receive the full report by the end of the day today. We'll publish it. Thanks, everybody. Thanks, COBRA, for hosting.
Sure. Lorenzo, thank you so much for that. Plus, this webinar will be back on in about 24 hours, we'll have a recording of this webinar, so you'll get another opportunity. If you didn't get all the stats, those fascinating graphs and statistics from Dr. Saville and Lorenzo, you will then be able to have a look at the webinar again. But as Lorenzo said, it will all be available on his LinkedIn, as well as on our website. You can pick up, as I said, a recording and other information with regard to this webinar and other webinars coming up. We've got an exciting webinar next week. Keep on watching COBRA. Also, just on one other marketing notice, besides for this one, which is Microsoft to help 25 million job seekers worldwide. We hear about this from Sia Mariebi and Charlene Versmotter. That's on Wednesday at 10. We've also got Kaz Kuvadia, who's from Business Unity South Africa. He's the first speaker in a series of 3, which also includes Martin Kingston from Business for SA, and Sandile Zungu of the Black Business Council. He's on the 10th of September. So 3 webinars in a series of webinars where we look how government and business can work together to solve our problems, our economic problems. But on Wednesday, that's the next webinar. Please join us then at 10 o'clock. Goodbye.